Good morning, traders. It's Kyle from K Capital. It's about 9:47, August 23rd. I wanted to go over the general market today going into next week. Obviously, as we've alluded to a few times, Thursday and Friday have been very bearish, and what we're going to look at right now is the general indices to get a general sense of where we're going and then our strategy coming out of that. So the first chart here is the Spider 500 or the S&P 500 SPY. As you can see, we had a pretty large breakdown here in the general trend last week. What we're looking at currently is the 1 week chart dating all the way back to 2008, which is right around the pre-recession time. What's interesting is you can see a somewhat similar pattern to where we had a MAD or EMA cross of first the 2500 and then the 5200. And obviously we had a very technical breakdown here. So similar, which is kind of scary, but again, we'll adjust accordingly. We always do, we always have. What we're seeing here is a very similar pattern in terms of the general setup to where we had a huge run up since 2009 and a cross back right in late 2010 of those moving averages. What we're seeing is a potential breakdown of those moving averages here. If you look at the general trend since the low, this will pretty much put our target for the SPY right around 170 range. That's currently where the 200 exponential moving average is, as well as the trend line. So that would pretty much give me severe confidence that this downtrend is going to continue. And again, the fundamental factors there are very detailed, but at a very high level. Quantitative easing is obviously being brought down by the Fed. Interest rates are most likely going to be bumped up come September, and the macro environment is pretty bearish in terms of China and some of the other emerging markets. So I think overall this is kind of a turning point for the U.S. markets in terms of where we're going to go. And if we continue, we can look at the SPX or the S&P 500 index itself. We can see that there was a general breakdown in the trend. Those same moving averages are even closer to turning, again, being very bearish, and completely broke down that level last Thursday and Friday. Again, this will put a target for at least the time being of the 1800 range, which is very far away. So again, that's very bearish. If we continue even to the Dow, we see similar patterns in terms of the breakdown. If anything, this is actually already confirmed in the Dow that those moving averages have crossed. And that, again, hasn't happened since, I think, late 2012 when we look at the daily chart. So again, it's something to kind of keep in our frame of reference for when we're going to look at in terms of our opportunities for the next couple of weeks. Because obviously we don't want to be trying to catch a falling knife, so to speak, and try and call the bottom. Because the bottom, obviously, if you tried to call that last week, you were completely burnt out, which is what happened to us in one or two of our plays. But again, I think we rebounded nicely with some of our shorts. So if we keep going, we can look at the Russell 2000, which is the majority of the positions that we trade in. They're small cap stocks. As you can see, we basically have a target here that we completely broke down. We're trading now below this trend line. We saw a complete breakdown of this support level, I think, late last week or early last week. And another confirmation really is the moving averages. So again, more bearishness, I think, in the overall small cap sector or small cap world. If we want to continue, we can look at the actual iShares Russell ETF. And again, the confirmation is really the same. The breakdown was the same pattern as we saw in the general index. Take that a step further, and we can kind of talk specifically about what we're going to be trading now. And really, it's going to be shorts in a very short-term time frame, whether that be a day to a week top holding period. We're going to stick strictly to our stops. There's no room or wiggle room in terms of our swing trading anymore in terms of this market. We have to be severely more diligent in terms of sticking to the stops. Obviously, in the past 2 to 3 years, we've had a nice bullish market to where we could let that slide in terms of our stops because the positions typically would rebound. Now they're not. So that's something that we have to change accordingly, and we will. So right now we're in LXRX, as you're aware. We're short at 11:30. We played this early, I think Friday, around the 90 range. It rallied right to our stop, and we sold to protect profits for a 5% loss. And then we saw some more bearishness in this late in the day. It rallied slightly, but again was sold off. And I think this fills this gap and breaks down this level here of 1050 range. And I think we fill the gap down. I think our initial target here is going to be 1050. We'll see how that trades after hitting that price. And then our stop is still going to be right around the high of Friday's price, which is, I think, 1175. So that's one of our shorts. The only remaining long we have that's a swing trade is Jack, GAKK. The only reason I didn't sell this is because I think that this dip here is still somewhat supporting this trend line. We had coverage initiated last week too by Oppenheimer with a 15% price target, so which is a nice upside here. But again, if the overall market tanks, then obviously it's something that we're going to have to get out of. So Monday morning, if this breaks down, we will sell. And then just to kind of recap, one or two of the positions that were on the watch list that I did not execute a trade for, but we would have been short, was OMER and CECO. And the reason I'm mentioning these is because this is going to be the type of opportunities we're going to look for now, where we have a significant downtrend, an overreaction in terms of, a typical gap up or a typical large spike, and then a sell-off into that. So this is exactly what happened here in OMER. It basically rallied high. That's when I put it on the watch list. We should have went short at the low here of this day, and then we would have basically added, I think, 3 to 4 shares in profit. We probably would have closed late last week. So it would have been a nice trade. Again, this is something that we're definitely going to look for now going forward. So just giving you guys the heads up that this is going to be our strategy for the next couple weeks, or cash. Because again, I'm not trying to call the bottom here in the market. There's too much volatility, and it's just something that hasn't happened for the last 5 years. So we have to adjust. There's really no other ways about it. You have to adjust, or you're going to be completely blown out of the market. So stay tuned. Again, just keeping the frame of reference of where we are in the general market. And really, this hasn't happened for a very long time. And again, so that's going to be our strategy, similar to LXRX or OMER. That's going to be our kind of short strategy. If you see any positions out there that you think match this strategy, or you think it could be possible good shorts, please let me know. I'll take a look at those. And really, let's just stay focused and stay diligent with our trading here. And we'll talk soon. If you have any questions, please just shoot me an email. Talk soon.